Hey traders, Nick Shaheen here, looking at American Express. Let's look at the daily. This is a 1 year, every candle is 1 day. Uh, Recently wrote it up as a long idea, and it has recently hit the target. That doesn't mean it's going to top out here. It just means that it recovered enough to where I might want to consider booking a trimming. Now, my idea was to go long, longer dated calls, and I chose way out, a few months out, around the $110 level. I didn't need it to get to 110. I just wanted to catch the move, and it has delivered. So the idea was to sell puts or put spreads, which I did, and buy calls or call spreads, which I did. So my entry cost is really lower than whatever I paid for the calls. In my case, I bought naked calls, and maybe we get a deal out of China that would open the door for American Express to go in there and expand. My concern is this candle right here. The levels we are entering now, the easy work is done off the bottom of the Christmas debacle. And up here, this is a big ledge from which they fell out. It's good that they cleared this little candle right there. I still worry about what's going to happen. Now, this is if I zoom in a little bit to see the price action with regards to volume, this is the upper edge of the eyeball value area where bulls and bears are battling it out the longest with the biggest volume. So it's a point of interest, this whole zone, and this is the upper edge of it. So anything above that is going into resistance. So lightening up now is a good idea, but there are other ways. So what if I don't want to get out of my position? What do I do? So I'm going to try to share an example and tell you what I would do or what can be done. So, okay, here's the options table for American Express. We're looking at several weeks and months. I chose next January 110. So I gave it a lot of time on the clock, and I did it a few weeks ago. I can't remember exactly when. Nevertheless, it's obviously green. It's now $6.50 or more. I don't remember my entry cost. It's about 5-ish, but really lower because I sold shorter dated credit put spreads to finance it. Ignore that. Let's keep it simple that I just paid $5 to get in, and now it's almost $5 to buy the one above it. And therein lies the opportunity. I can sell it back out and book the $1.50 profit per contract, or I can spread it. Usually I like to do a diagonal or a calendar where I sell something against it shorter dated, but all the premiums at 110, since this is so far out, are really piddly crap. So very low. I don't want to jeopardize my position to collect 20 cents. So what can I do? I can do the opposite of what I did, only one leg higher. What does that mean? Instead of selling it to book the profit and be out, I can sell the one above it for almost what I paid for this one. I'm going to assume that this was 5, just for easy math. So I paid 5 to open, and now I can sell this one and collect 5. So now I'm zero cost, but I'm in a spread that benefits if price goes up. This is price going up the chain, 110, 115. So if price comes to me, now I'm long with a debit call spread. A debit call spread. I bought this one originally. I sold this one today to lock in my profits. So I'm holding a bullish position, directional bullish position, and I would be holding a directional bullish position in AXP for free. So if price continues to rally, I hold this asset, and the spread, which is the asset, increases in price. So I can close the spread later on or stay in it until it matures. The maximum value of the spread is $5 because it's the difference between 110 and 115. And currently the difference price is less than 5 because there's still time on the clock and things can go the other way. So I can buy it at a discount now, which is what I would be doing, because in fact, I would be buying it for zero because of how I legged into it. This is a term that people use. I don't like to use it. It's confusing. But I bought this one, and then I got lucky. Price moved my way, and it's like, you know what? I can sell it and book the whole profit and be out, or I can sell something above it to lock in my profit and still be directionally biased long. So currently, the difference between the two is, again, for easy math, 6.5 and 5, so $1.50. So I can still profit $3.50 extra if price goes through, because that's the maximum difference between 110 and 115. So again, the value of the spread would be $5. Currently, it's only priced at $1.50, air math. So there's still $3.50 that they haven't priced in. Why? Because there's still time on the clock and price is below it. But as price rises, this $1.50 will be $2, $2.50, $3, depends on how high it goes. Ideally, if it goes through it, it should be $5 by the time expires. So I would be holding an asset still long for $0 out of pocket. And in my case, since I sold puts and put spreads, I would have been paid to be long American Express. So that's how I can manage profits. I don't necessarily need to just get out of it, although it would be simple enough. And if I would want to do that, to try to time it, I would get out of it and see what happens in the next few candles. If they clear this one, maybe I re-engage long, or I'll wait. If there's a dip coming, I'll re-engage long when they come back to a consolidation period zone, which is about $100.50. That is the plan on American Express. If you have any questions, let me know.